Jessica, the main story here is that the Terra complex fluctuating wildly. UST, this is TerraUSD stablecoin. The peg has blown out. The price has blown out. The peg is broken. It's extremely volatile. Looks like we're trading right now at around 48 cents on the dollar. Earlier, we'd been trading as low as 30 cents on the dollar. 4 p.m. last night, we were trading at 90 cents on the dollar. So this is just a massive blowout. Again, the peg has broken on UST. Let's move over to Luna. This is Terra Luna, trading right now around $3. It's off some 95%. Again, that's 95% price decline in Luna in the last 24 hours. A total collapse. It was trading at $25 last night at 4 p.m. when we did an update on this on the Real Vision Daily Briefing. Really swinging around wildly this morning. The Anchor protocol, this is the lending protocol, the governance token ANC, trading at 21 cents. Really just an absolute bloodbath. Bitcoin broken below the key psychological level of $30,000, now trading, looks like on my screen right now, 29,687. Your mileage may vary on all of these because they're fluctuating dramatically depending upon what price reference data you're looking at, Jessica.
And just to follow on from that, we're going to dive into UST just a little bit more because, Ash, as you've correctly mentioned, every market can temporarily lose its one-to-one peg. But the UST price drop really highlights a large issue here, and that's that dollar stablecoins aren't all backed by dollars. Stablecoins, as we all know, in theory, are less volatile than most other cryptos, and they peg their value to a more stable asset. Investors will typically lean towards them as they offer a way to diversify portfolios with stability. So what is UST and why are we talking about it today? Well, it was actually developed by a Singapore-based Terraform Labs, and UST aims to carry out the function of stablecoins like Tether, tracking the price of the US dollar, but without any actual cash held in a reserve to reserve back at it. So we're going to dive a little bit more into what we saw. Typically during a low liquidity and bearish market, we actually saw sales of a lot more UST than can be absorbed. And in return, this kickstarted other people selling UST, but also people minting Luna to balance out the price. And when we saw Luna starting to go down, you then saw a snowball of people trying to get out of both. So over the weekend, Ash, as you mentioned, hundreds of millions of UST was sold on Anchor, Curve, and also on Binance. And as a last resort, there was reserve funds of Bitcoin, which would typically help defend the UST's peg if it strayed too much. The funds were there, but the infrastructure wasn't yet in place. So Leslie, I would love to turn to you now and just ask you for your thoughts on what we've seen.
Yeah, I think the stablecoin narrative is really about a trifecta of factors. One being stability, right? You're depegging risk. Number two being transparency of the riskiness of the collateral that's backing your stablecoin. And I think the third point is redeemability. So it's the redemption and liquidity risk. And I think in the case of UST, all three are currently in question. So if we look over at Do Kwon's tweet storm or tweet thread, however you want to call it, really the big picture here is that he is trying to put in place a path to recovery so that UST can start to repeg. Now, he's had multiple tweets here and there indicating that there is some form of a plan. We don't see that happening yet. It's kind of just words at this point. But the question that I have on my mind, right, is how do we really start to rebuild a stablecoin when its sole job is to hold stability? And right now, the problem is it's got a scar. That scar being that, UST itself has seen a significant depeg from $1. And now we've got lost confidence among the holder base. At the end of the day, you can talk about the traders who are able to take advantage of this arbitrage opportunity, right, between the current price and $1. But on the other hand, you have, a whole host of holders who are really wondering what the future is like for them, either because they've plowed a whole ton of money into UST or they're actually using UST in an ecosystem like DeFi for other trading activities. So ultimately, it really comes down to this question of, a war between the people who believe Terra UST should be worth $1, and then people on the other side who are saying, No, it's not. So there's no plan forward, Jessica, right now for a UST repeg. We're kind of in this gray zone right now. But I know there are lots of listeners who are tuning in today who have this question, right? You mentioned that point of a Bitcoin reserve, right? To ultimately be that backstop mechanism in the case of a DPEG. And I see that we do have a user question that's come in on this topic. This is from Maria, and she's asking, do you think that the billions of dollars in Bitcoin that Luna Foundation Guard is sitting on, or any significant amount of it, could be dumped onto the market at any moment? Maria, the short answer is it's all gone, because the $3 billion of Bitcoin that was held in this reserve managed by the Luna Guard Foundation was deployed to help with this repeg mechanism. So this is, something that really loses, I think, confidence a lot of people, because this was supposed to be the go-to backstop. And now without this Bitcoin reserve, people are asking what's next. So Ash, do you have a further take on this whole UST drama that we're seeing?
Yeah, I'll be the cynical one here today, Leslie. Look, there are no financial perpetual motion machines. Algorithms don't magically create stability. This is a function of supply and demand. Look, I would say we are extremely, extremely early in this space. I said last night on the Real Vision Daily Briefing, these are science experiments. Sometimes the test tubes blow up. The paradox of science experiments is that while test tubes sometimes blow up, this is the way that the sum total of human knowledge gets advanced. People experiment, but people who are listening to this, people who may be putting money into this space, need to understand that these are not like stable, mature currencies. This is something that is very much in flux. It's being done on the fly, and sometimes things blow up. With regard to currency pegs, I would say that those of us who've spent some time in the macro space, for example, remember the 1997 Asian currency crisis. We've seen this movie before, obviously not with the specific terms in terms of the algorithmic component, but the Thai baht, for example, was once pegged 1-to-1 to the dollar. The Thai government couldn't defend the peg. Eventually, it floated and it cratered in the wake of the Asian financial crisis back in 1997. So again, there's nothing new under the sun. Pegs fall, prices blow out. These are not perpetual motion machines for money. Buyer beware.
So just to add on to that then, Ash, based on what you said, algorithmic stablecoins or collateral, where do we see the future for both? Is there going to be room for only one?
Well, anytime you have a floating exchange rate, something where effectively you have a market for something that's based on supply and demand, prices can move. And so, it's this challenge that folks want the ability to be able to have stable coins. And there are a whole series of different reasons for that. You want to be able to hold your trading reserves, for example, in something that's digital, not have to convert back and forth to dollars. There's the AML KYC issues overseas, particularly something we see in Asia. The reality is that this is obviously a space where there's a lot of focus on trying to figure this stuff out. There are other models, for example, DAI, where you have a kind of a programmatic pairing of DAI to digital assets where you can hold the peg in a slightly different way. But the reality is, I think the only way that you can get a reasonable sense of stability is the way that we've done it historically in the past, which is to have dollar collateralized reserves. Now, there are those who will say, well, that doesn't solve the problem. That doesn't find a mechanism to effectively have a pure digital straight through architecture where you don't actually have US dollars backing it. But the reality is, if the coin is trading in dollars at a peg 1-to-1, meaning it's a $1 coin, there's really no way to completely eliminate that risk with algorithms. There are no sort of mathematical magic that can be deployed in a way that always keeps these at a dollar.
Leslie, let's talk next steps, not just for UST and their recovery, but also for the entire stablecoin ecosystem. Where do we stand here, and how do you see things moving forward?
Yeah, I think what's really important, regardless of how you participate in this ecosystem, is to have a framework in place for assessing the attributes and risks for stablecoins. So I think it's always helpful to think in categories. Now, this is my personal view of how I look at stablecoins. You guys tuning in might have other ways of looking at it. But the first bucket really are the TradFi / fiat-backed stablecoins. So I would include stablecoins such as USDT, Tether, and USDC, which is Circle's stablecoin. And these stablecoins are backed by a mixture of dollars and cash equivalents, which include things like treasury bills, commercial paper, short-term bonds. And these are all held in accounts in US regulated financial institutions for the most part. So that is the first category, and they make up a large part of the stablecoin market right now. The second category really is the one-to-one collateral-backed stablecoins, and this includes DAI. So DAI is crypto collateralized, and it's rather safe because there are liquidation mechanisms that are put in place because of the way that it's governed by code, and also because it's over-collateralized as well. And so this actually brings me to the third category, which I call the volatile collateral-backed stablecoin category, which includes UST, so Terra stablecoin, USDD, which is Tron's newly launched stablecoin, and USDN, which is no longer, but is the first that launch of this pack. And really what categorizes this, this particular category is that it relies on the burning of an ecosystem collateral in order to mint the stablecoin itself. So regardless of the actual yield aspect, right, that subsidized yield that is often associated with the stablecoins in this bucket, in terms of just the collateral category, it is more risky than the other ones because it's effectively saying that, you know, you're issuing $1's worth of debt and investing that $1 into something that would go up and down in price, which is the case for Luna. So Ash, wondering if you have thoughts on that, whether it be on Terra specifically or on the categorization of stablecoins, whether you have other thoughts on how to look at this landscape.
Well, Leslie, I think that's exactly right and very well framed. Understanding the buckets that these get divided into, sometimes called taxonomy, that's the fancy word for how we divide these coins up functionally into different categories. Look, I think what you said was spot on. Yours and mine may be different. If you ask 10 different people, you'll get 12 different answers on how these are divided. But look, I think that the first and most important category, I guess you could cynically say there are two kinds of stable US dollar stable coins, those that are fully collateralized by US dollars and audited, and those that are not. So look, I think that the US dollar stable coins that are backed by US dollar collateral, if they are fully audited, if we go through the sort of process that we've seen in traditional finance to vet and make sure that the holdings really are there as they are claimed to be there, that is obviously something that has the potential to be more stable. But there are those who will say that doesn't really solve the underlying problem of having things in a straight through fashion, fully digitalized, fully on chain. These are some of the challenges that we're still sorting out, still working out. Look, when we talk about these like so-called algorithmic stable coins, there are a lot of challenges. You know, if you look at the Anchor protocol and their documentation, they use the phrase money market. We've seen challenges with the money market in traditional finance. We've seen money market so-called break the buck. I think they were paying 19.5%, roughly 20% return yield on this. There are a reasonable argument can be made that those levels are simply not sustainable, and that we're seeing here is the sort of ultimate ramifications of an unsustainable level of yield in this ecosystem. We'll have to see how that plays out. But I think you're exactly right. Thinking about these big picture questions, what the role of regulation and legislation, I know that's going to be unpopular in some quarters, but you better believe we're probably going to be hearing about it very shortly up on the Hill. We saw Janet Yellen, Secretary of Treasury, yesterday use Terra as an example and not as a good one of things that can be happening in this space. This is something that we are still in these very early innings of, but I think you're exactly right. We're going to have to sort of acid test the entire ecosystem. There's going to be a lot of vetting. Hopefully, if you're an optimist, You're going to say that when you see a failure like this, when you see UST breaking the buck dramatically, falling down to 30 cents, by the way, fluctuating dramatically, even as we have this conversation, that hopefully, there'll be a reckoning here. The old joke about when you have success, you tend to celebrate, and when you have failure, you tend to ponder. We need to do some pondering in this space to figure out what those buckets are, how stable coins are secured, how they are collateralized. And I think also what today marks is the end of this notion of the algorithm sounding like a panacea. Oh, don't worry, there's an algorithm that takes care of it. That's not the way things work. Supply and demand, ultimately, when people want to get out of a free-floating asset, they do, and the price can fall dramatically. Leslie, Jessica, thanks for joining us here on Real Vision, and thank you, everyone, for watching. Hey there, revolutionaries. Thanks for tuning in. For more content like this, head over to realvision.com/crypto and get unfiltered access to the most brilliant minds in finance and crypto. Join our community of lifelong learners for exclusive access, unparalleled education, and unbiased insights.